So the basics of getting a mortgage in Ireland for first-time buyers. The big question is always how much can I borrow? And that depends largely on your income. So in Ireland, you can borrow up to 3.5 times your basic salary. So if you're a single person, take your basic salary, multiply it by 3.5. If you're a couple, if there's two of you, add both your salaries together and then multiply by 3.5 times. So if you both earn, say, 50,000 euros each, that's 100,000 euros of earnings, multiply by 3.5. You could borrow up to 350,000 euros from the bank for your mortgage. If you have other payments like overtime or bonus, shift allowance or other kind of allowances, they can increase what you can borrow, but it is a little bit complicated. We would always recommend talking to a mortgage broker, mortgage advisor. Different lenders will give you different amounts when this is the case. So it's always worth talking to an advisor or broker so that they can advise you on where to go, that you'll get the most amount of money that you can if that's what you're looking to do. The second factor for first-time buyers is your house deposit. So no matter how much your mortgage is, it can't cover the whole price of buying a property. It can only cover up to 90% of the price. You have to have a 10% deposit yourself. Things that can count towards your deposit: savings that you have yourself, gifts from parents or other sources, and also the Help to Buy scheme, which will give you a refund on income tax. It's worth going on to and Googling the Help to Buy scheme in Ireland. That can be used to count towards your 10% deposit. And the third factor for getting a mortgage in Ireland is your repayment capacity. And what that means is, if you are taking out a mortgage, the banks want to see that you already are showing the ability to make a monthly payment equal to how much it's going to cost to repay the mortgage. So for example, if your mortgage repayments are going to come to 1,000 euros a month, the bank wants to be able to see that you're already either paying rent or saving over 1,000 euros a month. It's not just the exact amount of the mortgage. They'll want the mortgage repayment. They'll want to see that you can actually pay back more, because interest rates could always go up in the future, and your monthly repayment then could go up in the future as well. The two main things that count towards repayment capacity are rent, because if you're currently paying rent and you're going to buy a property, you won't need to pay that rent. You can divert it into your mortgage repayments. Or savings, because again, rather than paying money into a savings account, you can instead divert those funds and pay it into your mortgage instead. So those are the two main things that they look at